Good afternoon, everyone. Good afternoon, and welcome to day 2 of our first COL Multi-Asset Investing Summit. I'm Marvin Fausto, President of COL Investment Management. Welcome you all. Yesterday, we talked about the status and trajectory of the Philippine economy and how it would affect fixed income investments. We discussed that while we face challenges due to the new Omicron variant and the coming election, we could be looking at a much better 2022. And interest income from bonds will be a bit higher due to the expected increase in interest rates. For today, we focused on the themes for global investing, where we invited a global strategist. And then we will have a panel discussion with fund managers to talk about the local stock market. Our title for today's event, From Laggard to Leader, 2022 Investment Themes. We would like to share our latest investor survey to listen to your voice about investments. We believe that this could probably be the only survey out there that reflects the changing retail investment climate given what is happening here in the world. So let us look at our survey. What we did is that we asked our retail investors 5 questions. First, how is your financial situation today compared to last year, 2020? Second, have your investment considerations changed compared to last year? Third, what are your primary considerations when choosing investments? Fourth, in the past 6 months, which of the following products have you invested in? And then fifth, thinking of the next 12 months, which products, markets will you tap to allocate more of your investable funds? So let's look at the results. On the first question, how is your financial situation? Much better. Financial situation improved for about half of the clients. Better for 52% of the ones who answered. That's good. Second question, have your investment considerations changed compared to a year ago? And 67% of them answered yes. Majority changed their investment considerations. And for the third question, which actually is related to this, what are your primary considerations when choosing investments? And about 50%, or a lot of them, are really looking now more of steady growth with medium risk as an important consideration for their investments. And the last 2 questions, we asked about in the past 6 months, which of the following products have you invested in? And then we also asked, thinking of the next 12 months, which products or markets will you tap to allocate more of your investable funds? And the results are majority still in the stock market, Philippine stock market, 90% and then 86%. But what we are seeing that they are looking at other options like cryptocurrency, REITs. And what's interesting is they're looking now increasingly to overseas stocks and local and global funds. So global funds are increasing in interest. Okay, that's an interesting result. I'm happy that people are in a better financial condition. While people continue to invest majority in equities, interest is now growing in other options like global stocks and global funds, which is what we would like to cover today as well. To give a presentation on the global outlook, we invited an expert in global strategy. For this, let me introduce Ms. Trinh, the Managing Director and Head of Global Macro Strategy for Asia of Manulife Investment Management. She is responsible for developing macroeconomic strategy views of Manulife's Asia and global multi-asset teams. Before joining Manulife, she spent 13 years at RBC Capital Markets, where she was most recently the head of Asia FX strategy. And prior to that, she was on the foreign exchange desk of Bank of New Zealand and Deutsche Bank in Australasia. Ladies and gentlemen, to present her report entitled Diary of a Global Macro Strategist. Let us all welcome Ms. Trinh.
Thank you, Marvin, for the warm introduction, and good afternoon, everybody in the audience. Thank you for tuning in today. It's a great pleasure to be speaking with you all, especially considering it's late on a Friday afternoon. We very much appreciate it. My section is, as Marvin mentioned, on the global macro outlook. I've entitled it Diary of a Global Macro Strategist because I'll be walking you through our framework for thinking about markets. I've got about 15 to 20 minutes, and we do have Q&A as well. So I'll be discussing some high-level macro and market views. What's the outlook? Where do we see opportunities around the world? So let's make a start. Now, the number one question we were getting every day at the start of the pandemic was, what shape will the global recovery take? I'm sure you've heard this and variants of it, and maybe I shouldn't use the word variant, but will it be a V? Will we see the global economy taking a sharp turn lower, followed by an equally sharp rebound? Will it be more of a U, where we go sideways for a little bit after that down move before we end up ticking higher? A little bit more exotic shapes were the Nike swoosh. But in our view, that single letter shaped recovery framework was far too simplistic, and we threw it out. Really, since May of 2020, we'd been using this very simple 4-quadrant framework. It's a bit more nuanced and yet still simple for thinking about different macro regimes. So if we look at this quadrant in a little greater detail from the top left, we have the Goldilocks scenario. Now, historically, that regime has delivered the highest equity market returns, and that's typically very good for high beta markets, such as emerging markets. Over on the top right, we have a reflation regime. Equity markets do like that regime, but in terms of the historical data and the statistics that we have on that, it's not as good for equity markets as the Goldilocks regime, but still relatively good. It's the second best in terms of delivering decent returns. Now, if you turn our attention to the bottom half of this quadrant, it becomes a little bit more challenging in terms of the environment for equity returns. Bottom left, we have a stagnation scenario. That is not as bad, though, as the bottom right scenario, which is one of stagflation, so slowing growth as well as accelerating inflation. And the reason there is that it's a regime that central bankers will be very hard pressed to really address with the tools in their toolbox. So what has defined the last 2 years in markets is that we've shifted very rapidly in between regimes. I've used here the US 10-year Treasury yield just as a benchmark, and you'll be forgiven for having a little bit of whiplash over the last 2 years. Typically, a full business cycle is on average around 4.5 years. Now, the longest contraction or recession on record in the United States was back in the Great Depression in 1929, which lasted 43 months or 3.5 years. So we've been thrashing in between stagflation and Goldilocks now for the past year. And the jury is a little bit out in terms of whether the inflation backdrop is going to ease. We do have global supply shortages, which are wreaking havoc and causing a lot of befuddlement to the global central banking community. But this is an outlook, not a review of where we've been. So where to next? What does 2022 look like? Now, this is an example of the simple market mapping that our team goes through to ascertain the macro landscape. It's a kind of balance sheet accounting of the upside and downside risks in the investment horizons that matter to us. And when we sat down to map out macro regime factors, we really struggled to come up with upside risks to growth in the first half of 2022. What we found was that the list of downside risks got pretty long, actually. We found that we were forecasting PMIs turning lower. We expected Chinese growth to slow further. We were worried about fiscal tightening around the world, and of course, supply chain shortages limiting the ability of manufacturers to build their inventories, a slowdown in US consumer activity, and of course, energy shock, which is ongoing, not to mention the fact that developed market central banks, the major ones, are looking at tightening or reducing stimulus. Now, that was the first half of 2022 when we found that the downsides outweighed the short list of upside risks. But the good news, and it's important to focus on the light at the end of the tunnel, is that we do have the second half to look forward to. And that's a phase where we see finally that the upside risks become much more sustainable and start to outweigh those downside risks. So just a few examples of some of the really positive things that we expect in global macro in the second half of 2022. We're expecting the inventory build to really take shape. We're expecting CapEx or capital expenditure to also re-accelerate. We're expecting inflation to ease somewhat as hopefully supply chain disruptions begin to ease as well. And with luck, fingers crossed, the complete return to office as well once we get through the worst of the pandemic. Full disclosure is that I do think it's important to highlight the risks to our view. Our base case is that inflation will slow on account of base effects as well as easing supply constraints, ushering in a Goldilocks period in the second half. But the risk is that supply shortages do persist for longer, and that we get a stagflationary dynamic trying to win through, which is basically weak growth and also inflation staying much higher than we anticipated. And the current state of play of the global economy is underlined by these two charts on the slide. What I've shown is the city surprise indices for economic activity numbers as well as inflation. So economic surprises are the chart on the left, the inflation surprises are the chart on the right. And this really does capture that stagflationary dynamic that we could possibly be in right now. On the left, huge upside surprises in economic numbers coming out of the crisis initially in March of 2020, where actual data was better than expected. But momentum eventually slowed and crashed lower in August, where the net surprises were negative. If you look at inflation, you can see that's almost a vertical line higher, where inflation numbers have come in almost universally stronger and faster than anticipated, and there seems to be no signs of it easing or rolling over anytime soon. Now, inflation is very different of a characterization to the reflation that you might be hearing about. Reflation is that good kind of inflation when you've got demand driving price increases. Inflation that we see at the moment is largely on the supply side, where demand is really not keeping up. If you look at the University of Michigan consumer confidence numbers, for instance, you can see that consumer sentiment in the United States has been very striking for its collapse in spending plans. Those that think that it's a good time to buy a house or buy a vehicle collapsed to the lowest since the 1980s. And when you look at the reasons why that consumers put forward, they found that that prices were really just too high. That was the main reason that really saw consumers hitting the pause button. And of course, if inflation stays high for too long, then we would expect consumer demand to be crimped further. And really, it's no surprise when you look at incomes, for instance. Despite anecdotal news of labour shortages, wage increases, that hasn't really moved the needle at the macro level, the aggregate level. The picture remains one of wage deflation in real terms. So just as an example, if wage inflation is running at 5% and you've got inflation at 6%, net, the consumer is really not better off at all. hence the much more cautious spending plans. And when we put it all together, let's look at global GDP. In markets, there is this fixation with GDP growth rates. So when we had a situation where the United States went from minus 36% GDP growth and then plus 33% the following quarter, people cheered and applauded. But, hang on a second here. That's like saying if you had $100 in your pocket and it fell 10%, then increased 10%, you're square. When in actual fact, if you crunch the numbers, 10% increase from the $90 that you were left with after the 10% drop is really only $99, which is another way of saying that you're not incorporating the compounding in that kind of number crunching. Now, this chart shows global GDP in US dollar terms over the past 50 years. Normal business cycles from the 1970s to pre-global financial crisis, you would expect the difference between actual GDP and trend GDP to be around plus or minus 2.5 trillion US dollars. Now, since the GFC, that gap just got bigger and bigger, importantly, more and more negative. So, we are seeing the tiniest of improvements from the worst of it at the start of this pandemic, as you can see on this chart. But in US dollar terms, that gap at the global level is around 14 trillion US dollars at the moment in terms of the hole that needs filling. So it's not surprising that central bankers over the last 14 years since the global financial crisis have been just in almost a steady state of quantitative easing to try and plug that gap. Now, I've repeated that exercise from the last slide for Asian economies. I've added the United States for context here, and many recoveries that we will be seeing in Asia will be coming from a low base. GDP in most countries is still well below pre-crisis levels at the start of 2020, and the region is going to be entering 2022 with a lot of spare capacity. But the good news is, of course, that this will help keep a lid on the underlying price pressures. So stagflationary concerns are less of a concern in the Asian region. And it's a key reason why we think that central banks in our region will have more policy space, will be able to keep monetary policy much more accommodative for much longer to support fuller Goldilocks recoveries. Now, in terms of some key takeaways today, we're expecting 2022 to be a year of two halves. First half of 22 will be challenging. It will offer up some opportunities, though. We are expecting much more sustainable rebound coming in the second half of 2022. As far as inflation is concerned, we're expecting it to remain rather uncomfortable, at least through the first half of next year before it eases materially in the second half. Now, from an investment perspective, we think that there's lots of relative value opportunities. Some of the most attractive opportunities in our view will be regional and sectoral in nature, particularly as we try to adjust to the new normal of relatively tighter monetary policy around the world, particularly in the developed markets.
All right, thank you very much for that, Sue. A year of two halves, a challenging first half, but a more sustainable second half for 2022. I like that. I also like your chart on the output gap. You failed to mention the Philippines was the last in terms of the biggest gap. I think I kind of saw that. In terms of GDP output gap, Philippines is the one that has the, should I say, the highest upside? Is that what it means?
Well, there's a lot of opportunity for improvement. The reason why that gap between actual GDP and trend was so big is just really a reflection of how big of a hit that initial COVID hit had to demand. Of course, domestic demand is such an important pillar of growth in the Philippines that naturally the services sector basically being put on hold really hurt the Philippines. However, we do see relatively favorable news coming out on the fiscal and monetary front. The authorities do sound rather committed to returning growth back to a sustainable trend. So lots of opportunity and room for improvement for sure.
Good. Thank you for that. I have a few questions, some more. So if you don't mind, Sue, I'm going to ask you some of these things. The numbers on the COVID cases in general, they have been decelerating in general. No? But we are seeing countries like in Europe experiencing surges, more particularly because of this new variant. Where do you think the world is in this battle against COVID? Are we more on the tail end, or are we still in the middle of it?
There is still so much about this virus that even the scientists are learning as we go. And it's really difficult to say. I think that the market's reaction to Omicron really underlined that uncertainty. And the Moderna's chief economist or chief executive coming out saying that existing vaccines will be much less effective in tackling Omicron than earlier strains, that scientists hadn't anticipated such a highly mutated variant would emerge so soon, really was not helpful. But then again, if we have lots of people getting COVID or getting this new variant or infected by this new variant, and the symptoms are much more mild, then that would be great news. That's exactly what we want. So I think it will take at least a few weeks before we get greater clarity around just what kind of impact Omicron will have, both good and bad. So I would stress that it's not all bad news potentially.
Hopefully we're in the tail end of that. Yeah. So what are the main themes you're looking at in the global markets at this point for 2022? You mentioned that inflation is somewhat uncomfortable. What does that exactly mean? Is that the biggest theme that we're looking at next year?
It is. It's one of them. So supply chain shortages have been a huge driver of persistently high inflation. In fact, the latest CPI inflation number coming out of the United States had a 6 handle on it, for instance. We're unsure as to how long it will take to really resolve those shortages, as are the authorities. That was highlighted in Fed Chair Powell's testimony this week to the Senate Banking Committee. But we are hopeful that the combination of base effects as supply comes back on stream, that will pave the path for a little less uncomfortable inflation, and it will be able to see some kind of easing in the second half after a challenging first half of 2022, notwithstanding the uncertain handoff that we get from 21 to 22 on the back of Omicron and the likely volatile environment as we get greater clarity around that.
So if you look at looking at for 2022, where the audience also want to understand what are the opportunities outside, not just in the Philippines, but of course globally. We wanted you to give us an idea. What are the opportunities we can look at globally? Where are the growth? You mentioned regional and sectoral could be the most. What does that mean? What region, what sector can we look at for global investing?
Sure. I could spend hours on this topic, given I sit in asset allocation ordinarily. But if your starting point is one of uncertainty, if you will, and quite choppy backdrop, then we would advise a sort of a structural tilt towards higher quality, higher volatility, focus on money good, free cash flow, low debt names, for instance. It suggests longer duration, longer US dollar would be worthwhile tilts. In terms of the regional opportunities, we do have a strategic theme of more fragmented regionalized trading blocks. So it points to overweight select ASEAN, Taiwan as well, given its very strategic place in global supply chains, even to a degree Latin America. They will be beneficiaries of diversification of supply chains. We already see, for instance, Japan looking at ways, and not just Japan, looking at ways to get around these global supply shortages, to reshore. And that's going to be a fantastic opportunity for the Asian region, we think. At the sector level, the fact that COVID is likely to be coming and going in waves and affect affect in a very unsynchronized way the global economy. Staying overweight stay-at-home sectors, wireless telecom, interactive media, such as what we're using right now, those sectors look attractive still to us. And we also like overweight alternative assets. While rates globally are on the up as stimulus is withdrawn, we do see that yields in general are forcing investors to reach for just a little further out the curve. And where are we getting that yield from? REITs are still a very worthwhile asset class. We prefer residential over commercial, for instance, as people move away from the urban centres. And then just broadly, the perennial value versus growth question, I think we should redefine that. We see scope for a more barbell strategy that favours a kind of defensive growth as well as selective cyclical tilt.
Okay, let me try to see where I got all your questions or your answers. For regional, you're looking at ASEAN, Taiwan, Japan. These are the countries mostly favored, right? For the sectoral, you're talking about telecom, media, REITs, and the alternative assets. What are these alternative assets that you were mentioning?
Private assets, wherever you can find yield. We do find that crypto potentially has a space. You mentioned that at the top of the hour as you were making the introductions, based on the surveys, and we would agree with that as well. And why not? Given concerns about the state of the global economy, there is a case to be made for some allocation, even if small, to such assets.
That's interesting. So is Manulife investing partly in crypto now?
Manulife is not investing in that. We are a conservative Canadian institution, and nonetheless, we are looking at it as a thematic. Certainly on the global macro strategy side as well. We're not ruling it out entirely, but certainly doing a lot of work investigating the operational logistics of it.
So if I'm going to choose, am I going to favor more equities, global equities, or global fixed income? And if it's global equities, which, like what region, what area do you think we should consider seriously?
Well, global bonds, when we do our 5-year asset allocation forecasting, offer much less attractive yields than, say, other asset classes such as equities. So we would be tilted more towards the equities. We're not saying go underweight fixed income by any stretch. So when you look in the equity space, if you break it down to developed markets versus emerging markets, for instance, with the pandemic raging on, there is also a case to be made that DM, developed markets, can still outperform emerging markets, just because if you look at relative vaccination rates, access to vaccines, and then also policy space to try and offset any hits to demand from waves of COVID going forward. It's really the developed markets that are in a better position than EM. That said, emerging markets still offers good yield, and we wouldn't ignore it completely. Within emerging markets, we do prefer Asia over the other EM, for instance. Asia is in a much better position than 2013 when we had the taper tantrum, especially as the Federal Reserve is looking at raising rates sooner rather than later. We worry about the likes of Latin America and emerging Europe and their ability to really deliver enough policy support, given their debt ratios are a little bit more worrisome, and then current account positions are in a much better space in a much better place in Asia.
So I have to ask you this because a lot of our viewers are now probably just starting to look at the global markets, just trying to consider it, what they can start with. If you were going to do an allocation to diversify out of the Philippines, is there a sector or a fund or is it developed market fund, or what can we look at? What can these retail investors start with?
Well, seeing as I sit with an asset allocation, the multi-asset solutions team, I would recommend a diversified portfolio is a great place to start. It gives you the best of many worlds, and diversification, especially given the uncertainties that we're facing, represents good internal hedges. I think you don't really want to put all your eggs into one basket.
To diversify to the world, just you have a global fund, and that should be a good start. That's what you're saying.
Global fund is a good start as well. And then if you want to, become a little bit more nuanced, we do think, at least in the shorter term, in the first half of 2022, when the macro environment is a little bit more challenging, that the United States looks like it is in a slightly better position than the rest of the world, and to withstand any kind of potential shock from recurrent COVID waves. If you sort of think about the likelihood that the United States has hard lockdowns, it seems very unlikely given the rhetoric coming out of policy officials. Whereas if you look at Europe, for instance, where they're already engaging in lockdowns on the back of the Delta variant, so fighting the last war, we haven't even talked about Omicron, then in that way, we see that the United States might be looking like a slightly better place on a relative basis.
So basically, Sue, just to summarize it's let's look at global, but still in the developed markets, more particularly the US, because this is the country that can withstand if, for example, the Omicron variant just becomes like a Delta, something like that, right?
Yep, and let's hope it doesn't. But yes.
Yeah, I hope so too. Yes. Okay. Thank you very much for that, Sue. We have a lot of other questions. We will go through the panel. I'd like to thank you for giving us a view of what's happening in the world, and probably your views in what strategies to take. Thank you for that, Sue.
Thank you, Marvin.